To understand the 2008 financial crisis, don't start with Wall Street. Start with a house. For most Americans, a home is not just a building. It is security, it is status, it is the place where a family grows up. It is where paychecks become equity and where the future starts to feel real. And for a long time, the promise sounded simple. Buy a home today. Build wealth without doing anything more than making the monthly payment. It was a beautiful idea, and millions of people believed it completely. By the early 2000s, housing prices in the United States were climbing fast. Banks were lending, buyers were buying, builders were building, real estate agents were celebrating. Homeowners were checking their property values and feeling richer every year. The whole country seemed to agree on one thing: home prices only go up. That belief became the foundation of everything that followed the housing boom. Because when people believe an asset can only rise, caution starts to feel unnecessary. Borrowers take bigger loans, banks approve more deals, investors demand more products, and the system begins to stretch. At first, it looked like widespread prosperity. More families could buy homes, more neighborhoods were growing across the country. More money was moving through the economy, but underneath that growth, the structure was getting weaker. The housing market was no longer just about people buying places to live. It had become a machine that needed more loans, more buyers, more confidence, and higher prices to keep running. And once a machine like that starts moving, almost everyone has a reason to keep it going. Borrowers wanted homes, lenders wanted fees, Wall Street wanted products to sell. Investors wanted returns, politicians liked rising homeownership, homeowners liked feeling richer. Everyone was getting something from the story, so very few people wanted to ask questions. The question that mattered most was, what happens if home prices stop rising? A mortgage used to be simple. A bank lent money to a home buyer. The buyer made monthly payments. The bank held the loan and cared about whether the borrower could pay it back. That was the old model. But over time, the model changed. Banks and lenders could make home loans, then sell those loans to larger financial institutions. Those institutions could bundle many mortgages together and turn them into investment products. To the average person, that sounds complicated. The basic idea is simple. Imagine thousands of monthly mortgage payments flowing into one big pool. That pool gets packaged. Then pieces of it are sold to investors. Those investors are not buying one house. They are buying a slice of the flow from many home loans. In theory, this made sense. A large pool of loans could spread risk. Investors could receive steady payments. Banks could free up money to make more loans. On paper, everyone benefited. But here is the problem. When lenders no longer planned to keep the loans, their incentives changed. The question slowly shifted from, can this borrower repay the loan? To, can this loan be made, packaged, and sold? That shift mattered. Because when the goal is to keep feeding the machine, quality can start to decline. More loans were made to borrowers with weaker credit. Some loans started with low initial payments that could rise later. Some buyers did not fully understand how their payments might change. Some lenders were more focused on volume than long-term safety. And as long as home prices kept rising, the system seemed to work. If a homeowner struggled, they could refinance. If they needed to sell, the house might be worth more. If investors worried, the rising market calmed them down. The belief protected the machine. Home prices were not just numbers on a chart. They were the glue holding the entire structure together. And Wall Street kept building. Mortgages became securities. Securities became more complex products. Ratings gave many investors confidence. The language got more technical. The products got harder to understand. But the message stayed simple. Housing is strong. And when a message is repeated long enough, it starts to feel like fact. The payments are safe. The system is working, even when the foundation is already cracking. The first cracks did not look dramatic. They looked like missed payments. A homeowner here, a borrower there, a loan that reset to a higher monthly payment, a family that could no longer refinance. At first, these problems seemed manageable. The housing market was huge. A few weak spots did not seem like enough to shake the system. But the weak spots were connected. That was the part many people underestimated. A local mortgage problem could affect a lender problem could affect a security problem could affect an investor problem could affect a bank, and a bank problem could affect the entire economy. The housing machine had connected millions of ordinary monthly payments to some of the largest financial institutions in the world. So when more borrowers began falling behind, the pressure spread, home prices stopped rising. Then they started falling, and that changed everything because the whole system had been built around the opposite assumption. If a home was worth less than the loan attached to it, refinancing became harder. Selling became harder. Losses became harder to hide. Suddenly, products that had looked safe did not look so safe anymore. Investors began asking what was actually inside them. Banks began questioning what other banks were holding. Trust started to disappear, and modern finance runs on trust. Banks lend to each other because they believe the other side is stable. Investors buy products because they believe the numbers are reliable. Markets function because people believe that risk can be measured. But in 2008, that belief began breaking down. The problem was not only that some loans were weak. The problem was that nobody knew exactly where the weakness was hiding, that uncertainty was dangerous. When people do not know where the risk is, they start assuming it could be everywhere. And once that happens, lending slows, markets freeze, companies struggle, families lose jobs. A housing problem becomes an economic crisis. Then came the moment that made the crisis impossible to ignore. Lehman Brothers collapsed in September 2008. For many Americans, that was when the crisis became real. Not because everyone understood the details, most people did not, but they understood the fear. They saw the headlines, they watched markets fall, they heard that major institutions were in danger, and suddenly, the promise that housing could only go up looked very different. It looked like a belief the entire country had borrowed against. The 2008 crisis was not caused by one single decision. It was a chain, a belief that home prices would keep rising, loans made under weaker standards, financial products that turned mortgages into investments, ratings that gave people confidence, institutions that carried more risk than they appeared to carry, and a system where almost everyone benefited while the machine was expanding. Until it stopped. When the crisis hit, the damage moved far beyond Wall Street. Families lost homes, workers lost jobs, retirement accounts fell, small businesses struggled, communities were changed, and millions of people who never bought a complex financial product still felt the consequences. That is what makes financial crises so important to understand. They do not stay inside banks. They travel. They move through paychecks, home values, credit cards, job markets, local businesses, and family plans. A decision made in a conference room can eventually show up at a kitchen table. After the crisis, the United States changed parts of its financial system. Regulators looked more closely at banks. Mortgage lending rules became tighter. Stress tests became more important. Risk management became a phrase everyone suddenly cared about. But rules can only do so much. Because the deeper lesson is not just about mortgages. It is about belief. Every financial bubble has a story that explains why this time is different, a story that makes caution look outdated, a story that makes rising prices feel like proof. In the early 2000s, the story was housing. Housing was safe. Housing was stable. Housing was the American dream. And because the story felt so familiar, it became harder to question. That is the warning. The most dangerous financial ideas do not always feel dangerous at first. Sometimes they feel responsible. Sometimes they feel normal. Sometimes they feel like something everyone already knows. Home prices go up. Risk is spread out. The system is stronger than it looks. Until one day, the numbers stop agreeing with the story. And when that happens, confidence can disappear faster than anyone expects. The 2008 crisis was not just about houses. It was about what happens when an entire system starts treating belief as protection. It was about what happens when risk is moved, renamed, packaged, and sold, but never truly removed. And it was about the gap between what people thought they owned and what the system had actually built underneath them. That is why the story still matters. Because the next crisis may not start with housing. It may use different language. It may involve different assets. It may come with newer technology, cleaner charts, and smarter explanations. But the pattern can be familiar. Prices rise. Confidence grows. Questions fade. Risk spreads. And then reality asks for payment. The lesson is not that buying a home is bad. It is not that markets are bad. And it is not that finance itself is the enemy. The lesson is simpler. When everyone agrees that something can only go one direction, it is time to ask what happens if it does not. Because in 2008, America learned that a house can be more than a dream. It can also be a mirror. And for a while, that mirror showed a country that had mistaken rising prices for permanent safety.